Stablecoins are eating the world. There's a new governor joining the Federal Reserve, and AI companies are beating earnings estimates by the billions. Are we on our way to Valhalla or about to enter a dystopian recession? Hello and welcome to Milk Road Macro, the podcast that's here to remind you that sometimes it's best to just zoom out and touch grass. I'm your host, John Gillen. Today is Monday, August 11th, and we are joined today by Ram Ahluwalia, founder and CIO of Lumina Wealth, a digitally native investment advisor that specializes in alternative investments and digital assets. Ram has years of experience on Wall Street and a reputation for non-consensus investing that's focused on macroeconomics and identifying undervalued opportunities before they become mainstream. Unlike me, Ram is an SEC registered advisor who gives great advice. So if that sounds great to you, make sure you like and subscribe. Share this episode with someone who would enjoy it. I also want to remind everyone about the Milk Road Macro newsletter. Macro is confusing. We're here to fix that. The Milk Road Macro newsletter is your shortcut to understanding the big picture, how everything works, and how that moves the markets, delivered straight to your inbox twice a week. So make sure you hit the link in the show notes below to subscribe. And as a reminder, if you missed last week's episode of Milk Road Macro, we laid out a lot of our framework for how we think about markets. So make sure you go back and watch that episode. A lot of great value in that. Today's episode is brought to you by Figure Markets. Grow your cash like a bank, no lockups, just real returns, as well as Nexo, the platform that grows your crypto without locking it away. And without further ado, it is my pleasure to welcome back to Milk Road Macro, Ram. How are you, sir? How are you doing?
Hey, John, I'm doing well. Thank you. Thanks for having me. It's always a pleasure. Great to see you.
Yeah, great to have you here. So look, I think we should just jump right in. When I reached out initially to ask what was on your mind, you were very passionate about stablecoins, US dollar stablecoins with the Genius Act rolling out. And I was kind of surprised to hear that from a macro guy. Tell us what you're seeing there. What's the opportunity? Why are you so focused on stablecoins right now?
Yeah, look, stablecoins are very macro. And every decade or so, you have a new form factor that emerges. Usually it's the result of a technology innovation. Sometimes it's the result of a change in regulation. And in stablecoins, you have both, right? So you had the rise of mobile. That was a big deal 10 years ago. It propelled Apple, it propelled Meta. Fair Isaac, they get paid every time there's a mortgage originated due to regulation. Moody's and the ratings agencies are part of every securitization. This is technology and regulation coming together. If I look at stablecoins, here we have, for the first time in human history, that's how big a deal this is. With the first time in human history where I can send you, John, money without intermediation via a bank. There's no custody, there's no escrow, there's no third party, and it's done via the internet, and it's secured via cryptography. And now, due to the passage of the Genius Act, we're going to see a proliferation in stablecoins and a challenge to the old guard incumbents that have owned these payment rails.
Gotcha. Yeah. So I think that's a huge piece of technology that's being unlocked there. The competition in this space is already pretty intense. There's a lot of people who are in this who are crypto native. Circle, Tether, obviously the Circle IPO is huge. How do you see this playing out in terms of like winners, losers, incumbents, new challengers? How do you see that shaping up?
Fantastic question, right? And you've got PayPal that's involved. You have Paxos. Robinhood is teaming up with some others to launch their own stablecoin. You have big banks like JP Morgan and Citibank that will issue their own stablecoin or team up in a consortia. And by way of fun facts and statistics, there are 200 fintechs lined up at the OCC, which is the national bank regulator of the land, looking for a bank charter so they can get in the stablecoin business. This is a gold rush. Stablecoin investment is as hot as AI. So in terms of winners and losers, let's start with who the losers are likely to be. So the losers are incumbents. The Visa stock just hit their 200-day moving average, while stock markets are pretty much at all-time highs. MasterCard as well. I don't think that the impact of Visa, MasterCard will actually be felt for quite a few years. But markets price in recent information, they overreact, and then over the long haul, I expect we'll see multiple compression. By the way, I bought Visa the other day. So even though I have one view, I also have the other view because I think it's too cheap relative to the view, if that makes sense, right? Not investment advice, it's just entertainment, okay? The other are the card issuers. So Visa only gets a small fraction of the total economics that are charged to a merchant when a consumer swipes a card either online or in store. The card issuers are also banks. Those are credit card issuers. They range from the JP Morgans and American Expresses of the world to the Capital Ones, regional banks, to the extent they have credit card offerings. So the opportunity and the promise is that the 2 to 3% in what's called interchange income will come down. It'll compress. Maybe it's 35 bips, or maybe it's 35 cents as opposed to 3%. The reason why that's a big deal is that retailers, merchants, grocery stores, online sellers, they have very low net profit margins of about like 1% is the average net profit margin of a retailer. It's a hard business. So if you can cut your cost of payments from 3% down to 1%, it's a significant boost to the real economy. That's why I'm very excited about it. Interchange income is a tax on consumers and it's a tax on merchants. And these entrenched networks are oligopolies. I used to work with these firms in the past, by the way. So but I'm just calling a spade a spade. So that's one benefit. The second is on dollar funding and U.S. Treasury funding. So Treasury Secretary Scott Bessent said a few months ago that he sees potentially $1 trillion coming in to buy T-bills through stablecoin adoption, and that this is a way to advance U.S. dollar hegemony 100%. One of the most popular consumer apps in the world in Argentina is an app that allows a worker to accept US dollar-backed stablecoin as a form of payroll. Think about that. Mm-hmm. They don't want to make a bet on the Argentine peso. They'd rather see USD currency. So stablecoins are advancing global US dollar hegemony. People that think it's the end of the dollar and the BRICS are going to compete, they're really missing the mark. If you think about like our relationship with China, this has national security impacts. So imagine you're in the US and you pay your counterpart in China on the internet via USDC, and the Chinese government can't control that. Now you're starting to wean off Chinese entrepreneurial talent to the US ecosystem. It's not that China has an edge in robotics and EVs and batteries. It's entrepreneurs in China. So stable coins are strategic from multiple perspectives.
Gotcha. Okay. Yeah, really helpful analysis there. I think what I'd like to understand is when you say losers are going to be some of these like larger, techno monopolies on payments or whatever, these incumbents, it sounds like at the same time, you're also saying that their customers and clients are going to be winners because they're going to get a better experience and cheaper. Can you talk about that differentiation there, about like how it might not be as good for some of the incumbent monopolies, or not monopolies, but the incumbents, but much better for their customers and clients?
Well, here's an example. Suppose you go to a gas station. They say if you pay in cash, it's this price. You pay in credit, it's another price. They have two sticker prices for the same thing. You're going to see more of that play out at checkout. Let's say you're checking out from Amazon.com. You can pay with credit card. You can pay buy now, pay later. You'll see some type of stablecoin option. Now, we'll see what that actual user experience is. It's not going to say stablecoin. It'll be an intuitive form factor. Over time, it'll just be in the background, like your IP address. And they're going to start to steer consumer spending and behavior in that direction via rewards. By the way, the rewards we get today are from the credit card issuers. They take that interchange, like American Express membership rewards. They take a chunk of that and they let you buy airline seats, let you buy gift cards and merchandise. By the way, the quality of that's continued to decline over time. They inflate away the value of these reverse currencies. You get the one capacity control ticket that the airline can't sell now. So that'll be replaced by merchant-driven rewards to drive more adoption. If a merchant can close a transaction, the gains are significant. The average gross margin for a retailer selling a given product, not all products, not electronics per se, but a given product, let's say apparel, is 50%. And that's why buy now, pay later took off, because the merchant said, gee, if I can enable my end customer to get financed to buy a high dollar item like a fridge or a motorcycle, then it's worth me giving up 5 points of margin to close a 50% margin ticket. And you're going to see rewards being increasingly driven by merchants. and team up with other firms to do targeting. So another winner in all this, by the way, may be big tech. So big tech cannot run banks. There are very archaic laws like the 1964 plus or minus Bank Holding Company Act, which separates commerce from banking. Now we have that in other countries. Walmart is all over the US, but there's no bank branch. Amazon owns Whole Foods. There's no bank branch. Google has tens of millions of merchants on the one hand and hundreds of millions of customers on the other side. They have a network. They have a closed loop network. They could compete against Visa, MasterCard, but legally they cannot.
Gotcha.
So it's possible that those big tech firms have a role to play in getting to payments, and the big banks don't like that. The big banks have been trying to box them out, and they haven't successfully.
Gotcha. Yeah, I think something that's interesting to me about this Genius Act is that historically, in a lot of American legislation, banks have been treated in some way as special, or there's been like sort of a moat in a regulatory or legislative framework around banks and their businesses. And in this, it seems like there's much more opportunity for competition. There are still some hedges around on some things, but it does seem like the United States is trying to encourage a lot of innovation. I want to get your thoughts on how the rest of the world is responding to this. A lot of people are saying that the demand and the use for US dollar stablecoins is going to be largely from people who are already in the dollar, right? Like you said, customers at the point of checkout are going to get a cheaper option for payment methods once stablecoins become more adopted as a mechanism. But we've also seen the European Union and China getting very, let's say, nervous about their own CBDCs, pushing those forward, trying to roll those out. I've heard reports recently that China is trying to do a stablecoin for their currency as well, different from their central bank digital currency. At the same time, US dollar stablecoins market cap keeps rising. We're now over 270 billion, which is another new all-time high. So do you think that this criticism that a lot of this demand for USD is going to be from people who are already in dollars anyway, or is it going to come from other sources external and actually draw in more liquidity like Secretary of Treasury Bessent hopes?
It'll be both. On the former, the merchants will help drive that. Customers have a value proposition that'll drive adoption. And then internationally, it'll be remittances and cross-border payments. That'll be the segment of the market that can come on board now. So in the last week, we saw a number of announcements. Stripe is enabling Remitly to process cross-border payments with stablecoin. Stripe acquired Bridge a few years ago, which is enabling stablecoin payments, enabling, for example, SpaceX to pay thousands of employees around the world with stablecoin. Western Union made an announcement that they're changing their approach to payments. Those guys are at risk. If you have a mobile phone, why do you need to walk into Western Union branch, for example? So I think it's both. The US dollar is the least dirty currency in the world. It advantages the US dollar against these other currencies.
Why do people invest in real estate? Because it spits off cash flow. But I'm not here to manage rental properties. That's why I'm looking at Figure Markets. Their new democratized prime product backs your money with real cash flowing assets and returns up to 9% APY. It's the first real world asset borrow lend pool built for everyone, not just institutions. Ready to lend like a bank and get more than the 5% Aave is offering you? Download the Figure Markets app today and get 9% on your idle funds. Go to milkroad.com/Figure Markets.
If long meetings and judgmental bankers are your thing, Nexo's probably not. Nexo is a premier wealth platform built for people who value their time and money. It's built for people who have idle cash lying around and want it to grow fast. Whether it's Bitcoin, Ethereum, or even Forex-pegged assets like USDT or USDC, Nexo offers up to 14% annual interest and access to crypto-backed credit in under 24 hours. Your assets need a platform built for growth. Join Nexo.
Gotcha. Yeah, no, I think that there's going to be a lot of different sources of demand here, and we'll have to keep an eye on this and see how it continues to play out. I want to pivot to something you talked about before, which was funding the United States government, which is a big concern in Washington right now. Trump has nominated Stephen Murin to join the Fed Board of Governors, replacing Adriana Kugler. If he gets on, which he should, everyone expects him to, he'll serve through January of next year. But he has been very vocal about a lot of reforms and changes he wants to make at the Fed. A lot of people think he's going to be very much in favor of rate cuts because that's what Trump wants. How do you think about this nomination? How do you see this impacting markets?
Well, I think it's a hell of a lot better than James Fishback, the guy who was at Einhorn, who was like my quant, like a head of macro. The joke I say is like, if you ever watch The Office with Dwight Schrute, one of my favorite shows from 10 years ago, Dwight would always say, I'm the assistant regional manager, when in fact he was the assistant to the regional manager. Any case, look, I think it's fine. You're right. They're going to pick someone that's going to be very dovish, and Steve Moran is that. Steve Moran is be in that direction. I think anyone that Trump nominates is going to be in that direction. I thought Moran's paper on tariffs didn't make any sense. It was a word salad. I listened to a few of his interviews, but that's kind of neither here nor there as it relates to Fed policy. I also agree that there's opportunity for transparency at the Federal Reserve. It's coming to light that there was this Operation Choke Point 2.0, although part of that was Treasury driven, right? Jerome Powell actually approved Meta to issue a stablecoin called DM. And Janet Yellen, who's the head of the Treasury at the time, blocked that. That was reported in the Financial Times. At the same time, bank supervision rolls up to Michael Barr, who reports to Jerome Powell. And it looks like banks like Custodia were denied access to a Fed master account. And I can tell you, I've had a number of conversations with bank leaders who have told me how they experienced choke point, right? Your access to funding from the Fed would shoot up if you're engaged in quote unquote high risk activity, such as intermediating digital assets, for example. So I think it's fine. Look, the FOMC is a committee. There's a process. One person's not going to kind of stack the deck in one favor or another. Moran's fine, I guess, is what I would conclude at saying. And yes, you're right. He'll be more dovish.
Gotcha. Okay. So now I think the question on everyone's mind is, when will the Fed cut rates? It seems like once we got this revision to the jobs data where 250,000 jobs were taken out and Trump fired the head of the Bureau of Labor Statistics, it seems now like a rate cut is pretty locked in for September. Do you agree that that is an appropriate policy change, or do you think that that's premature or misdirected? Like, what is your view on the rate cuts?
We need to see what happens with the September non-farm payrolls report. So this is a replay of what happened last year at the exact same time. So remember, August 5th of last year, there's the backdrop of the yen-Mageddon carry trade unwind. And then you had the the early August non-farm payrolls report, and there was a miss. And then markets were very volatile to the downside. And then rate cut probability shot up dramatically. In fact, prior to the most recent non-farm payrolls report, the market's expectations of rate cut something like 20% for September. And now it's 80%. So it shot up on one report. Now, mind you, these reports have a big confidence interval around them. And two, there's a lot of seasonality at work. I've noticed this now for 3 years, by the way. It's always around now. You get some misses on NFPs. These are statistical models attempting to control seasonality with things like the birth, death, labor model. But you have a lot of dynamics in the economy, such as major inflows on immigration the last few years, and other things. I don't think you need rate cuts. What I think doesn't really matter as it relates to what will happen. What will happen will be determined based on the next NFP report. Overall, I don't see economic weakness. We can go there if you want. There's a lower pace of job creation, yes, but that seems to be driven by a lower pace of immigration. You can only create so many jobs. It starts at the top of the funnel from labor inflows. And if you look at the revisions go back, I want to say 5 months, which is shortly after Trump was inaugurated and had strong border policies. He was effective at essentially closing down the border. That has reduced labor supply growth. And labor market's clear. What that means is the supply of labor meets the demand for labor at some market clearing price. That's it. You have less labor supply, and you probably also have less labor demand too, but it's really not much to get concerned about. There's no recession here.
Gotcha. Okay. Yeah. I want to come to the labor market and what you're seeing there, especially as it relates to AI. But before we move on to that, I want to ask one more question about this. I think that you've mentioned Stephen Moran wrote several papers about Fed policy, and it seems like Trump, Besant, and Moran have all been kind of aligned around this objective of trying to get some measure of control of monetary policy away from the Federal Reserve and back under the executive branch within the Treasury Department. What do you think the likelihood of that happening is? What does that look like exactly? And do you think that would be a mistake, or would that be good? Or like, how are you thinking about the risks there?
Wow. Yeah, those are big questions. So if you zoom out, Daniel Kahneman, Nobel laureate economist, wrote this book called Thinking Fast and Slow. He has this framework called outside in thinking and then inside out thinking. Inside out thinking says, look at the particulars of the situation and kind of size up the people and the actors and what'll happen, is it good or bad? Outside in thinking says, look at the sample across history from a bigger perspective. So throughout history, what we know is that if you give the executive control of the money supply, they tend to print money. They tend to do that because they like to win elections. It's easier to print. It's easier to spend. It's easier to kick the can down the road. So from a longer term perspective, I'm not a big fan. Like, I think it's good to have independent Fed. The Fed also needs to be held accountable, though. Quantitative easing was a major mistake. These experience with ultra low interest rates was a mistake. But will they be successful at it? It looks like they don't want to remove Powell. They want to wait for a successor to come into play. Really interesting. There was a paper written by one of the potential Fed leaders who said that Treasury and the FOMC should just coordinate directly, given the deficit interest rate channel. That's really interesting.
Yeah.
By the way, they already meet weekly. They already have a weekly breakfast. Now, Fed policy, as you know, is driven by the dual mandate around managing inflation, unemployment, has no reference to the deficits. But the other practical consideration is that the U.S. government's already funding so much of its debt on the front end of the curve. Like, practically speaking, you're not going to change where you fund off the curve. You would if, like, the 10-year dropped massively in a recession, you start borrowing on the long end. Yellen should have done that a few years ago. She didn't. Anyway, but on the front end of the curve, are they going to say, hey, look, we want to lower the interest expense on the budget? I don't think they would. I mean, there's no austerity here. You've got 8% deficits. That's very stimulative. It's adrenaline for the economy. It's adrenaline for capital markets. And if you cut the front end of the curve, you're lowering T-bill income to boomers that rely on that and others that just recycle their treasury income to the real economy.
Gotcha. Yeah, no, so I think this is something that's really interesting, and it's not clear to me how it's going to play out. I think you're right in observing that the Treasury issuance has been for very short-dated bills. I think that's going to continue. But I do think it's interesting what you said about, like, maybe just formalizing the coordination between the Treasury and the Fed, because the reality is we're kind of in fiscal dominance. They're kind of aligned on this already anyway, and how much value is there in pretending that we're not? Who knows? I'm interested to see how that plays out, because I think the way that the market digests the change is more important than what the actual change is. I want to move now to something you referenced before about the labor market. In our Milk Road Macro newsletter last week, we wrote a lot about the recent jobs data, and we broke down a lot about how lower immigration and AI specifically are impacting a lot of things in the labor market right now. I've seen you write about this and make a lot of comment on this as well. You've called for a bifurcated economy as a result of AI. Explain what you mean by this. Walk our audience through this thesis you have, and how do you see this playing out as it relates to the labor markets?
Yeah. So today we already have a K-Street economy. We had a K-Street recovery, and you see it in public capital markets. You have Mag 7 and plenty of others, by the way, doing well, but you've got a lot of losers out there. That's going to play out in the rest of the economy. So the basic split is, are you AI forward or not? Imagine you're a regional bank. You don't have a great digital banking product. You don't have a stable coin. And now your competitors are offering online peer-to-peer payments frictionlessly and a better online experience and a customer service that doesn't involve any integrated voice response. How's that regional bank going to compete and survive? Same goes for others in the industry. So I think that the AI haves and the AI have-nots. The early winners from AI have been the picks and shovels infrastructure providers like NVIDIA, like CoreWeave, like Taiwan Semiconductor, on the semiconductor supply chain, really just kind of follow the money on the supply chain. They've done really well. They continue to do well. You're starting to see winners really in the last year or so with Meta and Google, who've been able to deliver offerings and commercialize that and see ROI on their cloud spend. Microsoft has seen that. Amazon has seen that as well, and Oracle. So there is ROI in ad spend. Now what's really interesting is how financial services will embrace AI. JP Morgan has a $12 billion tech budget that's bigger than the vast majority of banks in the country combined. They will be AI relevant. What about others? We'll see. I think there's plenty that won't be. I think there are opportunities for startups that are picks and shovels players to help that long tail become AI relevant. That's still very difficult to do, though. You got to rethink the user experience, from front end to back end. So what I'm expecting is greater separation in winners and losers. We already had a K Street economy. We had a K Street recovery. The slope of that K is going to increase even more. You're going to have even sharper winners, sharper losers, more winner take all.
So when you say K Street, you mean, I think, K-shaped recovery of like the the crash in April and the huge recovery we've seen since then. And what you're saying is that people who are employing AI are leading that recovery and will continue to.
Yeah, well, the people that will win in the years ahead are those that can integrate AI into their offerings to improve the customer experience or reduce their costs, right? Goldman Sachs, for example, has AI helping to reduce the cost of an IPO S1 filing by using AI to generate documents. What does this mean for like the legal profession? What does this mean for financial services and banking? There are a lot of industries that you can rethink with AI. NVIDIA's already got its own data center generating the next chip design. Humans can't even understand it. So I think there'll be a sharper separation in the winners and losers ahead.
Gotcha. Makes a lot of sense.
In the real economy, small caps and mid caps.
Right. Yeah. So this is
companies you want to think of as technology firms, non-technology firms.
Sure. So like the adoption of non-technology firms of the technology will differentiate them from their competitors. That's, I think, insightful. I think you wrote an article recently where you highlighted the disconnect that's happening between AI hype and real value being created for it. The Mag 7, like what you said, like some of the biggest companies are kind of pulling away in valuations and getting more and more inflated in their valuations, whereas the rest of the S&P 500, the S&P 490, call it, has been flat for several years. How much of this is speculation, and when does it change from being just speculation on AI to being like real economic value that's being created and real meaningful contributions to GDP as opposed to just higher asset prices?
There is real economic value. Like number one, the cloud year-over-year growth across Microsoft and Google and Oracle is 30% year-over-year. So that's ROI for the cloud provider. Nobody say, hey, Ram, well, those are the picks and shovels players. What about the users of the AI? We'll look at Meta. Meta's ad business is growing very quickly, in part to improve targeting due to AI. ChatGPT, which I think is overvalued, they're obviously seeing strong growth from AI. And you've got a ton of startups out there that are achieving very fast ARR revenue growth, even faster than you saw with SaaS revenue growth in the prior cycle. Now, we're not at a bubble yet, but you're going to see a lot of those firms shake out too, because the velocity of innovation hitting the market is significant. In the other categories, you are seeing adoption. I mean, it's hard to talk to someone that isn't adopting AI in some way and refactoring their workflows. Like everyone is improving their workflows, and productivity rates are strong and elevated, which is great. The only free lunch in economics is productivity rate. If productivity rate goes up, then earnings growth is higher and there's more room to increase the real income for labor. It creates a higher bid for labor. It's also disinflationary. The productivity rates we see now, we have not seen since 1996, which is about where I think we are in the AI cycle.
Gotcha. Okay.
The benefits are real.
Yes. Yeah, absolutely. Yeah. So I want to talk about the benefits and who benefits exactly. There's been a lot of people saying that artificial intelligence is going to lead to a lot of destruction of jobs and loss of jobs, turnover in the job market. There's a lot of fears that, the big revision in the jobs data we saw is sort of a precursor to a recession that's coming and a lot of lost jobs. But there's a lot of other people on the other side of this who argue that AI is going to, not like you said, increase productivity, but also create a lot of new kinds of jobs. Where do you see this shaking out? Is this like we're in 1996 and we're about to have a boom in a whole new industry, or is this going to kill a lot of other industries and lead to big problems in the labor market? Like, where do you see that playing out?
It's a rapid velocity of transformation. No, I don't think there's a big spike in unemployment. Like when Easy Pass was rolled out to help you get from one state to another, you had the toll booth, card punchers went away, but they got other jobs and it created more value for the consumer. You could tell the same story about horse and buggies and all the rest. So it's hard to know what that new job is. All people see is the immediate pain. They say, okay, maybe this is bad. But look, unemployment's actually low. Where you're going to see is more growth in healthcare, right? You have aging demographics. Boomers are retiring and you're not having enough kids. The demographic period is inverting. So you're going to see jobs in care for the elderly and care for the young. Those jobs today cannot be disrupted by AI. I don't think humanoids are going to be online fast enough to provide the tender warmth and care that a human being wants to be able to display itself also. But that's where the growth is. Healthcare is the only category over the last 5 decades that continues to grow year after year after year. There's no reason why that would stop now. There are also other industries I think will do really well, like travel and leisure, right? Travel and leisure is doing really well in the market. If you look at the high end of the market, people are traveling more. The airlines are doing well. The demand for travel and leisure is going to go up because people will have more time. So I think that's an interesting area to play. The value of land will go up because that's truly scarce and cannot get disrupted by AI. Certain defense names, maybe like Anduril, I think could benefit, like refactoring what U.S. Weapons platforms look like in the age of AI and drone warfare. Healthcare, how do we think about the transformation of telemedicine to AI? I'm sure we've all done diagnostics with AI. You take a picture of a bug bite and you say, what happened? And how do I think about this? So that's happening. So there's a lot of benefit that we're seeing seep across the economy. No, I don't think you're going to get a big spike in people losing jobs. You will see in certain white collar professions, just smaller groups of people, and you're going to see the more talented people get more impact with fewer people underneath them. That's what's going to happen. Their scope of productivity is increasing tremendously. There are lawyers that can crank out docs very efficiently. They don't need 5 associates on a deal. That means that you'll have lower number of people going into those professions over time. The labor market is going to adjust. That's a normal thing. That's a healthy thing. It'll mean greater value for everyone in the economy.
Gotcha.
It could be challenging for apprenticeship though, right? Like training the craft of the next generation. It could be a challenge for like critical thinking, right? I saw a posting the other day how like Gen Z satisfaction is dropping off a cliff at the same time as their social media consumption is increasing, and like ability to focus. Like I think if you have critical thinking skills and the ability to focus and you develop that before the age of AI and social media, you have a superpower. Like millennials might take over the world because of that. And maybe Gen X.
Well, if you're giving it away, I'll take it. I want to kind of drill in a little bit more on this because I've heard sort of this similar sort of thinking from a lot of people, right? That like the best people in the field are going to be able to amplify their impact, and the lower level jobs are going to be at risk, but there's going to be greater productivity and greater impact from experts in the field. Doesn't this, in your mind, or at least in mine, doesn't this contribute to the ongoing real problem and perceived problem of wealth and economic inequality in the country? And how do we protect against that? Doesn't that make this a big risk to the market?
John, I love the questions. Your big picture, you're looking at everything. I love it. You're absolutely right. So that K shape impacts wealth creation, inequality. If you are a founder or you are a high agency person with a strong work ethic, you're going to do extremely well. That doesn't mean you have to have the wealth to do well. Your cost of entries to anything has dropped. So that's one way to address this. It's an enabling and empowering tool. If you are an incumbent and you've got an established business, your business may be at risk Now, others will do just fine, though, if they're AI forward. But you're right, though. Overall, you are going to see more wealth creation happen at rapid rates. You're going to see more inequality, but not necessarily because of AI. There are other issues at hand, too. And also depends on your market you're in. I was in Dallas last week. It's the number fourth or fifth largest market. There's a lot of talent flowing from California to Dallas. They have a lot of engineering talent. The cost of living is half the price of, say, New York metro area. There's more entrepreneurship, culture, better tax and deregulatory framework. Like if you want to create wealth, think about going to like Dallas or Phoenix. You can build a business quickly and cheaply, and AI will enable you to get a lot more done. Creatives, I think, will do really well. For a long time, creatives were easy to get disrupted. Photoshop, you offshore the job. But if you have personality or you have content like your podcast, your productivity is going to increase. You're going to have avatars that allow you to multiply your personal brand across different digital channels. So yeah, I think I agree. Inequality will go up, but I wouldn't blame technology. I wouldn't blame technology per se. There are a lot of other structural issues at work. We had a student debt is in the trillions of dollars. That was because the federal government under post 2008 under Obama scuttled Sally Mae's role into private education. There's no kind of accountability to student lending. You could learn whatever you wanted. There's no private markets discipline to say, hey, look, we're not going to finance studying a random subject that can't get you a job in the real world. So there are other issues at play.
Gotcha. I appreciate the insight on that. I think it's one of those things where it's like, hey, we can see this as a concern. There's a problem coming. And maybe the only real advice you can give someone right now is to try to find the opportunities as opposed to the dangers, and to lean into those.
We're all better off for it,
Sure.
right? If you and I and a million other people were trapped on an island and then Elon Musk showed up and he created wealth and suddenly he's worth $1 billion, we'd all be better off. We would all be better off, right? If you want to create...
I was going to say, I don't want to be trapped on an island with you and Elon Musk, but other than that, yeah.
We'll have a life raft in the back. We'll have like escape pod, rocket booster. But, if you have, you create wealth by serving others. I'm a staunch defender of capitalism. I was reading Ray Kroc's biography. Many people may have seen an incredible film. It's called The Founder, the story of Ray Kroc. And there's a section of this book where they say, Ray Kroc may have created more millionaires than anyone else by people saying, I will open up a McDonald's franchise. How many people did that? How many millions of people are millionaires now because they made that decision decades ago? And then you have shareholders, of course. They're modern versions of the McDonald's story.
I really appreciate the insight and the perspective on this. We're coming up on time here. I have a lot of questions I'm not going to be able to get to, but I want to get one question in here. You are very famous for being a non-consensus investor, and you try to get to narratives before they become mainstream. One that I'll just flag when we don't have time to unpack this too much, but I think your firm was one of the first that identified Ethereum as being a big winner when the Genius Act finally started to get traction. Tom Lee and a lot of others picked that up at a time when everyone was bearish on Ethereum, and I think that was a great example of this, non-consensus, forward-looking, and like beat the mainstream to these opportunities. Tell us a little bit about what clued you in there, and then what are you seeing now? What is the thing that the narrative that you're seeing that you're most excited about that the rest of the market's missing going into the second half of this year?
Appreciate it. First off, thank you for the recognition. We were very early on Ethereum in June. So the thought process there was, hey, which chain benefits from stablecoins? Where's the most stablecoin activity happen? It's on Ethereum. That was it. Stablecoins actually compete with Bitcoin as a form of electronic peer-to-peer cash, which was Satoshi's title of his white paper. It doesn't mean that Bitcoin can't do well, certainly can and will, but Ethereum is a beneficiary because it is a form of programmable money. Others like Solana will do well too, but Ethereum is uniquely positioned, and a lot of institutions on Wall Street, they've been thinking about Ethereum for a long time, right? Like BlackRock is focused on Ethereum. Structured products, you can do smart contracts and run payment and royalty streams and program that waterfall, with Ethereum. So you're going to see a lot of that. A lot of institutions, I think, will adopt Ethereum. So where we see things now is, I think the next non-consensus idea is long-term rates are going to come down. They're grinding down now. Like mortgage rates are coming down. They're quietly coming down. The 10-year is coming down. This is 2 months after Ray Dalio went viral on Twitter with the debt explosion thing. And that was the day that rates tip-tocked, and now they're heading down. So I think like mortgage refinance companies can do well. You've seen home builders have done really well. If you look at the last 3 months, home builders have this quiet, sneaky rally that no one's talking about, but other rate sensitive categories as well. So like I like mortgage refinance companies. I own Better Mortgage, for example. They're mortgage refinance. I think that category, which has been hurt by higher for longer rates, is going to benefit going forward.
Interesting. Okay. So to kind of tie things up here, it sounds like you don't see a recession. The labor market's not going to get destroyed. You're very bullish on stablecoins. This is going to benefit a lot of consumers at point of sale, and a lot of other businesses are going to be challenging incumbents. So there's opportunity there. Look for ways to benefit from the opportunity from AI as opposed to get caught up in the crisis and danger. And then just keep your eyes on the horizon for refinancing, for rates coming down, and stay bullish.
Phenomenal summary. Yeah, I think that's great. Look, you might get some summer tailwinds, but overall stay bullish. On stablecoins, I think you're exactly right. The incumbents are at risk, including the leaders in the stablecoin market today. The question is, how do you express a view on that? And it's going to be a private company that no one's ever heard about. It might be a bank at the middle of traditional finance and digital assets. So you're going to see 1,000 flowers bloom. This is a VC land grab, and we'll have to see who those winners will be beyond, as you pointed out, the merchants and consumers. Thank you, John. This is terrific. Really enjoyed it every minute.
Absolutely. Where can we send people to find more of you and your work online?
Oh, thank you. You can follow me on Twitter at Ram Ahluwalia, RAMAHLUWALIA. I know it's a mouthful. Or you can go to Lumina and sign up for the Lumina Ledger. It's a newsletter I write and I release every Sunday at 12 p.m. We're also on LinkedIn. So TikTok and where you consume social media.
Awesome. Thanks so much for being here. Really appreciated the conversation. Thanks for joining us, everybody, and we'll see you on the next episode.
As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.